If you are one of the people who bought a house in the last 2 years, and now all you can do is think about how you're going to get wrecked when this market crashes, you're right, you probably are. But that's why I'm here. You and I are going to take a look at an investment strategy so ridiculous it just might work. It probably won't, but it might be fun to try. So you bought a house at the height of the market. Congrats, that means you're richer than me. Although that doesn't mean much. Richer than a guy with less than 100 subscribers on YouTube? Good for you. You'll probably need to buy some booze to help you sleep at night when this bubble pops. Or you could just buy futures. That's right, we're talking about buying leveraged derivative products on your leveraged physical asset. Watch until the end to learn about hedging your home value with futures. If you're watching this video, I'm going to assume you know what options are. If not, I have some other videos that dive into that a bit. Well, futures are the less exciting version of options. If options are the cool, tatted up family member that smoked weed in middle school and rides Harley Davidsons when he's 40, futures are the boring accountant brother. The buyer of a future has the obligation to buy the asset underlying the contract at the expiration date. The main difference here is the long call option contract has the right to buy at expiration, not the obligation. That's why the option contract was the cool guy. Lots of fun, lots of leverage, but no responsibilities. Because of this lack of optionality, this means that futures contracts typically move pretty closely in value with the underlying asset. A potential advantage of futures is the fact that they employ a moderate use of leverage, meaning it takes less capital to enter the trade. For these reasons, futures are often an important tool for hedging risk. You could hedge with options in a similar way, but they usually cost more than futures because they will have premiums associated with them. The premium cost needed to hedge out a house price will be unreasonable for most people. And I know you guys have no money to spare with the prices I saw you paying, so we'll stick to futures. Housing prices may be volatile in the near future. The bear case for real estate has two parts. The Fed has been raising interest rates, which have an inverse relationship with housing prices. Rates go up, house prices go down, but I'm sure you knew that. The other headwind is increased supply of houses hitting the market. Housing inventory jumped 19% year over year. Increased supply will put downward pressure on prices along with the increased rates. The Chicago Mercantile Exchange offers futures on 10 major markets in the US, and many brokerages will allow you to purchase this kind of futures contract if you have access to a margin account. Bearish investors can go short on a futures contract, and if the security loses value, the investor gains money. Therefore, to set up the hedge, an investor would need to short a future on the housing index that is most closely linked to their house's value. A housing futures contract is priced at $250 times the underlying index. If, for example, the San Francisco index is now at 386.76, the value of a contract based on the Bay Area benchmark would be $96,500. To fully hedge the median priced home in San Francisco of $1.5 million, 15 contracts should be sold. But you will be able to use margin to accomplish this hedge. It will still take a lot of capital to hedge this out, probably more than you have given the markets. In that case, if you're poor, a partial hedge is a good alternative. Real quick, if you're still watching, you must think I'm a little funny. Make sure you subscribe to see more smart money content. An interesting way to think about a full hedge is locking in the price today for the future. This could be especially useful for someone looking to sell their house at some point soon. The futures contract would gain value as your likely selling price goes down, offsetting the change in market value. Theoretically, if you own a home and you go short on the index, if the real estate market in your area plunges, your house will lose value, but the loss will be offset by a gain in the futures market. But if the market does well, your home will increase in value and you lose on the futures investment. One risk to consider with futures is basis risk. This represents the difference between a contract's underlying index and the value of a given home. For example, basis risk arises when your house value drops by 10% and the futures value only goes up by 8% because it doesn't perfectly hedge your house. This difference will become larger the further from the major market the house is located. A home in the major city will move closely with the index compared to homes in the suburbs, which may have less correlation to the index. Other risks include margin if you don't fund the entire futures contract with cash and you borrow money from your broker. In addition, it may seem obvious, but it should probably be pointed out, housing prices could continue to rise. If this is the case, futures positions would lose money because you are short and the price increased. Finally, futures contracts are for a set period of time. This can be problematic if the price moves you're expecting don't play out in the period you are hedged for. The contracts can be rolled to cover longer periods of time, but this would likely be expensive to continue. So there you have it, the most ridiculous way to save your home value. If you found this interesting, watch this next video from Smart Money.